In today's video, I am going to talk about the rising interest rate environment we are experiencing right now. So this video is being shot on May 13th, and interest rates are beginning to creep up, and inflation is out of control. For the past 2 months now, inflation has really been moving up quickly, and people have felt it. Just last weekend, my wife and I went out. We each got a cup of iced coffee and one baked good. I got one, she did not. So 3 small items. We got medium cups of coffee, and the cost was over $15. It's like $15.60. And I'm like, hey, Tara, look at this. And we live out in the middle of nowhere, by the way, in northeastern Pennsylvania in the Poconos. So we're not in a metro city area, meaning if we went to the city and bought that, it would cost even more. My point is, inflation is a real thing right now, and a lot of people are feeling it. So when it comes to whole life insurance policies and how dividend rates work, and even insurance companies and how they are responding to inflation and rising interest rates, what do? How have they responded in the past? So I am not an economist or interest rate expert by any means. Really, where my level of strength is, our company's level of strength and expertise is in whole life insurance products designed for maximum cash value, with designing them today, and also looking at what policies and companies have done throughout history. So we do have knowledge as to where insurance carriers are placing their money and exactly what the net returns or net growth rate on cash value and death benefit on real policies has looked like over time, if that made sense. So we're going to look at history today, and what I'm also going to share is my conversations with insurance carriers, my opinions on the moves they've made over the past couple years, and really where I think things are going with interest rates, just based on the moves insurance carriers have made and the conversations I've had with some of the top insurance carriers. So this one will be a lot of fun. Let's get on into it. To begin, we're going to start with some history. Before we just jump to 2020, because that's where I'm going to spend the majority of my time on in this video from 2020 onward, I'm going to start with the 1980s and 90s. So I was born in 1988, so I did not know what was going on when the hyperinflation period and high interest rates were occurring. I was either not born or I was in diapers. I was a baby. But it was real when that time period happened, and it's interesting when we look at the history regarding life insurance, particularly cash value life insurance products, what happened back then. So when we look at whole life insurance policies back then, they were around. They've been around for a very long time. And when we look at dividend interest rates, where were they? Well, if we were to look at dividend interest rate history, back in the 80s, they were at all-time highs. The reason why is because interest rates were at all-time highs. So if we take a look at history here, what do we have? So here's some historical interest rates from 1980 through 2020. We just pulled this from Google real quick, very simple chart. And we see in the early 80s here, 1980 to 1984, look at that. Bank prime rates were over 18%. Right? At different points in time, we could get a CD for 12%. Mortgage rates were even higher than that. It was a high interest rate period. So when we look at whole life insurance products, what did their dividend interest rates look like? Well, here is some dividend history with Guardian Life Insurance, one of the major mutual companies. And if we go back to the 1980s, let's go 1980 through 1990, what do you see here? Look at that, 86 to 87, 13.25%. That was the highest we've seen the dividend interest rate with Guardian at any point in time. If we look at another company, let's take a look at Mass Mutual. What do we notice here? On the left, things start here, 1980, go all the way down to 1990. What do you notice? At that same point in time, right, 85 to 86, not 13.25, they're at 12.2%. But as interest rates increased throughout history, dividend rates followed. The reason why is back then, insurance companies could just purchase bonds, long-term bonds, if it was a 20-year or 30-year T-bill, and just hold on to the thing. When I say T-bill, treasury bill, and if that was paying 16%, they could hold on to it, and it was a safe area to position money. Remember, when insurance companies are acquiring assets, they look for attractive returns, but those assets also must be very safe, because the insurance carrier must maintain strong safety ratings and financial ratings. If they can maintain a AAA rating, that's what they're interested in. So it was very easy for them to do so back then. Now, as time has passed, what's occurred? Well, we see that dividend rates have come down as interest rates have come down, and assets that insurance companies can acquire that are safe and also credit attractive returns have become more and more difficult to find. Insurance companies have still done a phenomenal job when you look at where they are actually investing their money. I have seen their bond allocation gradually decrease over the years, especially when we study the 4 major mutual carriers and where they're going as far as alternatives are concerned. A lot of high-end commercial real estate in metro city areas, multifamily units, a lot of times we'll see that. Mass Mutual, for example, will invest very heavily in other companies. They do have a venture capitalist division, so they'll invest in other companies and sometimes outright acquire other companies. And you'll see a lot of life insurance carriers do that. But again, they're looking at safe areas to position money where they can still drive attractive returns. They can't just dump a ton of money in the market. So back to the dividend interest rate history here. Very high at this point in time. But relative to where interest rates were, if my dividend rate is 12 or even 13%, is that attractive relative to what was available at that point in time? When we look at the interest rate history, not really. In fact, whole life insurance sales struggled at that point in time. If we go back here, the reason why is whole life policies with the respective dividend rates couldn't keep pace with inflation and interest rates. So life insurance carriers had to innovate, and they came out with new products. The new products they came out with in the 1980s were universal life insurance policies, and in the early 90s, variable universal life insurance policies. Now, with the universal life insurance policies, these were interest rate sensitive products, meaning they could participate in the current interest rate environment. This way, if an individual, say you lived back in this time period, you're interested in a high cash value life insurance policy. You love the idea that it can grow tax-free and it can distribute income tax-free in the back end. That attracts you. Okay, whole life, that's okay, but relative to what's going on in the interest rate environment right now, assuming you lived back then, not gonna cut it. This guy, on paper, looks phenomenal. The reason why is because the illustrations run back then. If you've seen any of our other videos where we go through an illustration, which is the projection, here's how much money I pay into the policy, here's my cash value growth over time, and then here's the dividend rate and or internal rate of return. Maybe it's 4%. Well, back then, if we look at a universal life policy, it could be run with an assumption of 16%, because that was the interest rate back then. So how would that look? Imagine if we could run an illustration today and assume a 16% crediting rate. Say it's a 16% dividend rate. I don't care what it is. How good do you think those numbers would look? Well, they would look phenomenal. Here's the issue that occurred back then is with universal life policies, universal life insurance, there's a big difference between universal life and whole life. They're both cash value life insurance products. Meaning as that cash value grows over time, it grows tax deferred, and I can access it completely tax-free. That's where a lot of people are attracted to the cash value component. The key difference, however, is with a whole life insurance product, you have a guaranteed rate that will always exceed the insurance expenses on the policy. So with a whole life product, if I'm going to be laser focused on the guarantees, I'll see them continue to increase. Whereas with a universal life insurance policy, when I look at the guarantees, in almost every scenario, they'll go down to zero. The reason why is because the insurance expenses exceed the guaranteed rate on that universal life insurance policy. Sometimes the guaranteed rate is 0, sometimes it's 3%, but often you'll see the expenses exceed the guaranteed rate. So back then, guarantees might have been very low, or they were very low. However, interest rates were high. So put yourself in this position. You're considering a policy back then. You like the cash value life insurance aspect, being that it's tax-free, pay a premium. Death benefit starts out level, often with the universal life policy, but eventually increases. And there's your cash value just skyrocketing over time. With a universal life insurance policy, We have COI. This represents cost of insurance that gradually increases over time. With universal life type products, whether it's standard universal life, variable universal life, or today indexed universal life, no matter what happens, the insurance expenses gradually creep up over time. Each year as we grow older, the expenses go up. So this happened back then. However, if the illustration is being run at 16%, guess what? Those costs are never even going to come close to the growth rate. 16% is going to easily outpace whatever the cost of insurance is. Now, if you ran a conservative illustration back then, what would be conservative? If rates are at 16% today, if I run this at 9 or 10%, reducing it by 6%, would that be conservative? Again, pretend that you live back there in that time period. Probably. Going to drop by 6%? I can't see that happening. Just like 5 years ago, I can't see interest rates ever going back up to where they were in the 80s. When we're in the moment, our judgment is typically different than when we look back on history. So, what ended up happening with these universal life insurance policies is they did not produce 16%. Interest rates eventually came down over time. And just to sum things up, those costs ended up exceeding the cash value growth, and the values went down. A lot of policies lapsed. In many cases, policyholders were forced to pay in larger premiums to keep their policies in force. If people had distributed income from their policies and had a large loan balance on the policy, and then it was at risk of lapsing, or if it lapsed, that triggered ugly situations where large taxable events occurred. There were a lot of lawsuits. It was ugly. Now, as far as whose fault this was, I don't know if it was necessarily anyone's fault. The insurance companies did not deliberately do this, in my opinion, say, hey, let's set up a bad product that we're just going to have tax bombs down the road. At the time, they probably viewed it as, hey, whole life insurance sales are not where we want them to be. Let's innovate and create a new product based on the interest rate environment right now. Things are very, very high. This should really, really serve our customers well and drive sales north. So they innovated, came out with a new product. And then if we could go back in time, seemed like a good idea at the time, but man, we shouldn't have done that. Or we should have structured the policy differently as far as how it was equipped. Anyway, I think you get my point here. It didn't quite work out, and a lot of issues with universal life insurance policies. But whole life insurance policies that were purchased back then, and the individual or corporation, because corporations still purchased them back in this time period, just stay the course, how'd things turn out for them? Well, the policy was purchased back in the 80s or 90s. The internal rate of return, call it the actual growth rate, produced somewhere between 5 and 6%. No risk, not tied to the stock market, economy, nothing like that. That's the net rate at the end of the day. Let's actually take a look at some policies. Got different time periods. Here's a policy, or policies that were issued in 1984. 20-year study period on a 45-year-old male. We've got your 4 major mutuals, Mass Guardian, New York Life, Northwestern Mutual. There's your actual internal rate of return. They had a phenomenal time period back then, Northwestern Mutual. And there's different studies we have that validate why each company is better than each other. I should say each company provides studies validating why they're the best. Here's the strongest internal rate of return. They always go back and forth and fight with each other. My opinion is when we look at different life insurance carriers, 4 major mutuals are my favorite because I've seen them consistently deliver strong internal rates of return. When a policy is designed properly, if I select one of those 4 major mutual carriers, hard to go wrong. You can literally close your eyes and pick one of them out of a hat, and we'll see strong results. We always have seen strong results. Nothing against smaller companies. We're still working on obtaining the proof. But we see internal rates of return. That was through 2004. If we've continued to hold on to the policy, that's a nice, safe area to position funds over time. Let's continue on. So, some history here that whole life insurance over time through the upswing of interest rates and inflation, and then the downswing has just been that consistent area to position money. And by the way, I've got access to it to take advantage for other opportunities with the unique loan feature and such. But what's happened in more recent history? Because what's going on right now, inflation is real. Interest rates have begun to come up a little bit. So if we go back a couple years, so we're in May 2022 right now, if we go back to January 2020, an update occurred in the insurance industry. Had to do with mortality tables being updated, and at that point in time, insurance companies had revamped their entire portfolio of whole life insurance products, and term and universal life, all of their products. But with whole life insurance products, what happened at this point in time, so this was a mortality table update, the guaranteed rate remained at 4%. However, when we looked at the non-guaranteed performance, the non-guaranteed values, there was a big difference between what was originally available and then the newer products. Had a conversation with one of the major mutual companies. It was Mass Mutual, two guys at the home office that knew their stuff. We were talking about the new products, and just to get to the end of the story, they made a comment about their new products. They stated, the new products, the new mortality tables and the new whole life products that we've released are more dividend sensitive. What that means, or the follow-up statement they made, is our feeling at Mass Mutual, this was in 2020, is that the low interest rate environment we're in right now is going to remain low for at least another 10 years. Now, what happened after January 2020? If we fast forward a couple months, March 2020 occurred. What happened then? The world changed. COVID hit. With respect to interest rates, what happened? Interest rates went down even further. They were already low. There was talk of interest rates finally beginning to raise a little bit or rise a little bit, and then they started going down even lower. They're getting slashed because there's a shutdown, a global shutdown. People were panicking. I remember at that point in time, there's a bank we work with, and they actually started their first BOLI policy. And the reason why, what had really motivated them to take action right then and there, was because they saw interest rates going down. And they've got their fingers on the pulse a little bit closer than you and I and the average individual, because they're a bank. They've got insight that we don't have, or they receive information quicker, I should say. But the comment was, we'd like to position a sum of cash into a BOLI policy because it's sitting there in cash and we want to put it somewhere safe that pays an attractive return. That was their point of interest because interest rates were going down at that point in time. So what's interesting here is you've got 2020. They make a comment, one of the major mutual life insurance companies, 10 years, we're expecting interest rates to remain low. 3 months later, COVID hits and changes everything. That accelerated everything, in my opinion. 2021 through 2022. What happened here in the insurance industry? There is an update to Section 7702. Basically, what happened is the guaranteed rate on whole life insurance policies, that had been at 4% since 1980. Let's take a look here. So here's another dividend history sheet with Guardian. 2021, 4%. I'm going to scroll down here. Let's keep going. What do you notice? 1980 is when the 4% guaranteed rate began. Before that, it was lower. But it was 1980 through 2021. Then what happened in 2022? Well, with the Section 7702 update, this allowed insurance companies to reduce the guaranteed rates on whole life insurance products. Instead of a 4% requirement, now all companies have the choice to select the guaranteed rate between 2 and 3.75%. And this is applicable to all new whole life insurance products. If you have an old product with a 4% guaranteed rate, you're locked into that, which is great. But The reduction in guaranteed rates, what that results in is lesser guarantees for policyholders. From the insurance company's perspective, the lower the guaranteed rate, the lower the guaranteed death benefit is, which is a liability on the insurance company's books. Remember, as a life insurance company, what is the first and foremost obligation? To pay out life insurance claims. So if I, as a life insurance company, can have a lower guaranteed rate that allows me to lower my guaranteed death benefit, and I'm on the hook to pay out a lesser death benefit unless I'm able to produce high returns. And then on the non-guaranteed side of the life insurance illustration, it can really produce over time. But I shift the risk away from myself to a degree by lowering that guaranteed rate. The same premium, if I'm just shopping for a death benefit on a whole life insurance product, the same premium will purchase me less death benefit now. If you're designing a policy for maximum cash value, which just about everyone we work with does, not a huge difference on the cash value side of things. We can still design a policy in the same manner. But a lot of additional info. Why did this happen? I had a good friend of me asked when we were talking about this, why did insurance companies push for this change? Because they lobbied very heavily for it. Well, when COVID hit and interest rates began to come down even further in 2020, that, call it, put the nail in the coffin. Insurance companies were already struggling to maintain the guaranteed rate of 4% when things started to get cut even further, because remember, they already had anticipated that the low interest rate environment was going to remain low for at least 10 years. And now all of a sudden, things go down further, like, okay, we can't handle this. You have to let us change things. They were required to have a guaranteed rate of 4% back in the 1980s. Like, make life easier for us, please. Insurance companies, all insurance companies, or I should say most, lobbied very heavily for this change, and it was passed. So now they can have lower guaranteed rates. So again, why did it happen? Well, low interest rates, as far as what has occurred for a long time now, the low interest rate environment, and also the anticipation that interest rates will not be going up, not a whole lot at least in the near future. If they felt that interest rates are going to shoot up, would they have lobbied for this change? Perhaps, but at the same time, having a contractual guarantee of 4% from a marketing standpoint does not hurt at all, especially for those that are very, very focused on the guaranteed rates or guaranteed values on a whole life insurance policy. So with all that said, past 2 months, and this is as of the day we're shooting this video, which is May 2022. What's occurred the past 2 months? That's been much more apparent. It's been going on for a little bit longer than this, but it's really been in everyone's face the past 2 months. Inflation, it's real. People are feeling it. Interest rates have started to move up just a little bit. When we look at it over the past 10 or even 20 years, hasn't moved up a whole lot, but it's started to go up. What happens all of a sudden? Everyone starts to panic. Interest rates, inflation's very high, interest rates have to be hiked, they're going to continuously be hiked, and it's going to be the 1980s all over again, depending on which internet guru we look at and what media outlet we look at. Here's how I look at it. Throughout history, what has been the case? Well, whole life insurance policies that are properly designed with companies that have a track record of delivering strong actual cash values and death benefits have been a solid area to position money. When we look at what the wealthy are doing, what corporations are doing, still what banks are doing, they're looking at these high cash value life insurance products. Often, wealthy individuals and corporations will look at whole life insurance due to the guarantees, and it's just that safe, secure asset continues to appreciate over time. Oh, and by the way, a death benefit comes back that's guaranteed as well. So often what happens here, we hear this question, does whole life insurance still make sense? Being that the net internal rate of return will hit 3 to 5%. Realistically, to set expectations properly, that's what I think it will do, 3 to 5%. If dividend rates do go up, yes, it could do a little bit better, but I'm not comfortable stating 4 to 6, for example, like I used to several years ago, because I don't think that that'll happen. That's my opinion, just based on product performance and everything as we look at it. But that 3 to 5% which is what? Safe, not invested in the market, going to happen no matter what. Liquid, I can access it anytime. Remember on the liquidity piece, if I'm earning a 4% internal rate of return, and I elect to borrow against my policy, let's say you've got $100,000 in cash value, and you elect to take a $50,000 loan, what happens? You've got a cost to borrow that goes to the insurance company or the bank if you're assigning the policy as collateral to them to get a lower loan interest rate. But that 4% IRR, what happens here? Is it credited only to your remaining $50K equity? Remember, you borrowed half, so you've got $50K still available that you can borrow? No, the 4% is still credited to the full $100,000, as if you never touched it in the first place. It continues to compound, keeps moving forward. A lot like borrowing against a piece of real estate that constantly appreciates over time. So I can leverage it as much as I like. We hit on the safety piece already, that 3 to 5%. And then you've got the tax-free piece, which is huge as well. Oh, and as my good friend Dr. Ace tells me, don't forget the death benefit, Steve. I don't want to forget the death benefit either. Point to all of this is when we are on the battlefield, in the moment. Right now, inflation is real. There's a lot of noise that interest rates will go up, and they very well could. But when we're in the moment, emotions get caught up. We often don't even realize it, and we make decisions where we would look back and say, it probably wasn't such a good idea. I know I've been guilty of that many times, and I'll probably do it with, many things in my life, many times over my life. My point is, when we can look back at history and say, okay, what has always worked, regardless of what has happened regarding a place to position my money. Whole life insurance kind of is what it is. That internal rate of return of 3 to 5% over a long period of time, is that an area that I'm comfortable positioning my money? Like the banks do, like corporations do, like the ultra wealthy do, like they have for a long time. So just to put this in perspective, am I comfortable with it from a logical standpoint and also an emotional standpoint? Hope this one helped. From a historical standpoint, just providing some insight as to where insurance companies think that the interest rate environment is going. In my opinion, they've made a bet that they don't think it's going to increase in the near future. Back in January 2020, when I spoke with them, they stated this, and the recent 7702 change also validates this. And then a couple months after the 7702 change, we start to see interest rates hike up a little bit. But long term, what's actually going to happen? Insurance companies, they know what they're doing. They have for a long time. They've got their finger on the pulse of the financial sector to a much greater degree than most people do. So I hope you enjoyed this video from an educational and informative standpoint. If you did, please hit the like button, subscribe. It certainly helps us a lot. And we'll talk to you soon. I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.